Have you ever looked at your retirement savings and thought, am I truly ready to retire? Will my savings be enough to live a life of comfort and excitement? If you feel that way, you're not alone. In fact, a staggering 70% of Americans feel like they're not on the right track for retirement. But no one wants to keep working until they drop or live off Social Security. That's why we're going to walk you through secret strategies and hacks that will help you maximize your retirement savings and make your money work harder for you. We're also going to tell you how to decide how much money you need to retire and the costs you have to account for, so we've got it all covered. By the end, you'll leave this video with a roadmap to retirement success that will leave you feeling confident and in control. Welcome to PST Finance. You can't plan for retirement without knowing exactly how much money you need to retire comfortably, so here's how to determine your needs. A quick search on the internet or here on YouTube will show you many influencers telling you that you need $1 million to retire, but that's not what I'll tell you. In fact, there's no set amount as it depends on your income and your lifestyle. To determine this amount, you need to budget and understand your current financial situation well, then identify your future obligations and envision where you want to be in the future. If you're watching this video and are in your 20s or 30s right now, it's easy to forget about things like medical costs or setting aside money for your kids. But these are significant expenses you need to account for when saving for retirement. This is why you need to ask yourself if you should be saving for things like a long-term health insurance plan or opening a custodial account for your kids. It's really important to get good insurance. You might hate paying for it now, but you definitely won't regret it in case of an emergency. There are some common rules in retirement that could help you determine the amount of money that you need, such as multiplying your annual spending by 25 or your annual income by 10. For example, if your annual expenses are around $50,000, then you'd need $1.25 million saved up to retire comfortably. Using the second rule, if your annual income is $150,000, then you'd need $1.5 million saved up to retire. Of course, there are no set rules since economic conditions change over the years, and the money you have saved up could be affected by that. So you'd need to be a bit more flexible with the goal you set. To make things simpler, you can use a retirement calculator that helps you calculate the amount of money you'll need based on factors like your current age and income, as well as the age you want to retire. After finding out how much money you need to retire safely, you should start saving as soon as possible. To start saving for retirement, you should be spending less than what you earn and have all your high-interest debt, which is anything above 7%, paid off. This is because paying off big obligations can lift a huge weight off your shoulders, and you can actually start saving comfortably and dedicate a big portion of your income to it. If you start saving in your 20s, the common rule is to contribute 15% to 20% of your paycheck, and this will likely help you meet your retirement savings goal. If you can't afford a 15% contribution right away, then you should just contribute as much as you can and work your way up as long as you realize that the earlier you start, the better. Now that you have an idea of the basics, let's discuss the tips that will help you make the most of your retirement savings. The first tip is, take advantage of the free money your employer offers in a retirement plan. Some employers offer 401k retirement plans and match your contributions to them. For example, if you contribute $200 each month to your 401k and your employer matches it, you'd have $400 in your retirement plan each month. It's basically free money from your employer, but your employer might not match the full amount and contribute at a percentage, meaning that if you contribute $200, they might contribute $100 or $50. If this is the case for you, you might find it a good idea to open other retirement accounts besides your 401k, like a Roth IRA or a traditional IRA. When you separate your retirement savings over multiple accounts like that, you could follow a 3-bucket pension strategy. With the bucket approach, you divide your retirement assets into separate buckets of assets based on periods of time. Of course, those time periods can be flexible, as can be the number of buckets. For example, you might want your first bucket to be a retirement account with savings that would support you for 5 years after retirement. After this runs out, you can use the savings in the second bucket, which would support you for up to 10 years. And finally, you could move towards your last bucket for the rest of your retirement. One approach is filling your first bucket with short-term, low-risk liquid holdings of cash equivalents and cash, so you can cover your expenses without tapping into your stocks and other investments. Then your second bucket could include a mix of bonds and equities, and the third bucket could be focused on growth stocks because it has the longest time horizon. This strategy is helpful because it adds a psychological aspect to saving for retirement, as you could become more confident when you know that you have certain assets and income sources set aside in different accounts for your anticipated future expenses. Another good tip for making saving for retirement easier is automating your savings. You can set up an automatic transfer from your paycheck or checking account to a retirement account to ensure that you actually make the payments each month. After setting up your retirement account or accounts, you'll need to decide what to invest in using them. A general rule calculates the percentage of stocks you need to have in your retirement account, and it is 120 minus your age. For example, if you're 20 or younger, your portfolio needs to be 100% stocks, but if you're 30, your portfolio needs to be 90% stocks and 10% of a less risky investment like bonds. Of course, you can always invest in an S&P 500 index fund with a low expense ratio, which is offered by platforms like Schwab and Fidelity at 0.03% or less. But if you want something that requires less involvement from you, you can invest in a target date fund. Target date funds are structured to maximize returns by a specific date, such as your retirement date. Generally, these funds are designed to build gains in the early years by focusing on riskier growth stocks, and then they aim to retain those gains by weighting towards safer, more conservative choices as the target date approaches. Examples of these funds include the Vanguard 2065 Fund or the Fidelity Freedom Index 2045 Fund. Target date funds usually mature in 5-year intervals such as 2035, 2040, and 2045, and their expense ratios could range from 0.08% to 0.62%. Even though the automation target date funds offer is considered a great asset, it can also pose some risk since market conditions could change, making stocks a better investment than bonds or vice versa. To counter this problem, you should invest in a target date fund that reaches maturity before your retirement date. For example, if you plan on retiring in 2052 but don't like the risks of market volatility until then, you could buy the 2040 or 2030 fund instead of the 2050 fund. Another way to do it is by putting, say, 70% in the 2050 fund and the rest in other funds, which would create some sort of ladder that will help you receive your money in phases and reduce volatility for your whole portfolio while having a one-stop fund at the same time. So you now know what to invest in and start contributing money to your tax-deferred retirement plans, such as a 401k or an IRA, and you're thinking about how you'll use that money one day when you retire. But when is that exactly? It's common knowledge that you can only withdraw money from your retirement accounts when you're 59 and a half years old. But what if I told you that there's a loophole that could help you retire earlier and withdraw money without forcing you to pay a penalty? This loophole is called a Roth IRA conversion ladder. It works by taking the money you have saved up in a traditional IRA or a 401k and moving it to a Roth IRA, which allows your money to grow tax-free forever, unlike the previous two. In addition to that, a Roth IRA allows you to withdraw money tax-free as well. By creating a Roth IRA conversion ladder, you're ultimately asking the IRS to tax you on the money you withdraw from the 401k, then put that money in a Roth IRA, where it'll grow tax-free. By now, you're probably wondering how this would help since you'll end up paying the taxes. Well, the trick is to do this when you're at a very low taxable income. For instance, let's say you've retired in 2024 and have zero income, but you have annual expenses of $50,000. You can create a Roth IRA conversion ladder by pulling out $50,000 from your 401k, and that $50,000 is taxable, but you're getting taxed at $0 of income. This means that you can take the standard deduction of $14,600 and be taxed on just $35,400 from the original $50,000. At that income level, you fall into the 12% tax bracket if you're filing for taxes as a single person. So you'd end up paying just $4,016 in taxes on $50,000. You can even get into the 10% tax bracket and pay less money if you're filing for taxes with a spouse. So if you want to find out how the new tax brackets work, check out our video on the 2024 tax brackets. This method is great because it allows you to grow your savings tax-free and withdraw the money only 5 years after you create your Roth IRA account. So if you retire earlier, you won't have to wait until you're 59 to use that money. If you do this conversion process each year and create a ladder, then you can pull out all your money from the Roth account completely tax-free. And for our next tip, we suggest that you find a company to work for that offers equity compensation. While cash compensation can be great, having equity in your company, especially if the company has a great future outlook and growth opportunities, can help you make much more money over the long term. For example, if you receive equity compensation of 100 stocks worth $1,000, meaning that the share price is $10, if the stock appreciates and the share price becomes $15, then you'd have 100 stocks worth $1,500. On the other hand, if you just took a $1,000 cash compensation, you'd miss out on the extra $500. This could really help you out when saving for your retirement, since it removes actual cash from your hands that you might be tempted to splurge on things you don't need and puts it in stocks that can appreciate over time. However, you shouldn't depend solely on that, since having a lot of equity in one company can be very risky if something happens in the company or industry that could cause it to lose money and value, leaving you to rethink your entire retirement plan. So you should be focused on diversifying your investments, and you don't even have to spend money on stocks to do that. In fact, you can sell some of your equity compensation shares and use that money to invest in other stocks. As for our final tip, you could get a buffer asset that will help you transition from your employment to retirement or hedge against the market risks that could harm your investments. This is because buffer assets are very low-risk assets whose values don't change in the same way as the assets in your investment portfolio. They include investments like cash deposits and premium bonds. You can use the buffer assets to cover the first few years of spending when you enter retirement. This allows you to practice adaptive spending and know if you need to bump up or decrease your annual expenses without having to dip into your stock portfolio. On the other hand, you can use buffer assets by treating them as reserves in your retirement, meaning that you can keep a big pool of money off to the side that you can spend in the years when your portfolio is down. This can help you reduce risk, but there's a trade-off. Holding buffer assets means that you are holding money back from your investment portfolio. So you need to decide on the perfect balance between your investment portfolio and your buffer assets. To sum up, there are many methods you can use to save up for retirement, and we try to show you some that can help you get the most out of your savings. Of course, these methods can be changed and customized depending on your needs and how much money you can actually contribute to your retirement accounts. Still, the most important thing you need to know is that you should start the contributions as early as possible in order to achieve your retirement goals, as well as the great importance of diversifying your retirement investments, because we don't know what the future holds, so you have to be prepared. Well, that is everything for now. What do you think? Will you be following any of these tips? Please let us know what you think in the comments below. And if you haven't, please subscribe and leave a like for this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.